The markets are just bleeding red. And for once, it's not the usual suspects pulling everything down.
Right.
We're seeing this massive coordinated sell-off in global software stocks.
A huge one.
And the narrative, I mean, the story driving it is honestly terrifying for anyone holding those shares.
Yeah.
It's all AI disruption fear.
Right.
It's like investors have suddenly woken up and are asking if the business models we've relied on for a decade, the whole SaaS model, are about to be, I don't know, vaporized.
Vaporized by the very technology they're all trying to integrate. It's a moment of absolute reckoning.
It really is.
You got this sudden, pervasive panic that AI isn't just a tool that makes software better, but a replacement for the software layer itself.
Exactly. Why buy a seat license for some complex dashboard when an AI agent can just do the work without the interface? That's the fear.
That's 100% the fear. But you have to wonder, is it grounded?
Well, that's the thing, because you have the counterpoint right there in the mix. NVIDIA CEO, he came out immediately after this rout and called the fears misguided.
He had to, didn't he?
He did, but he's adamant that people are completely misinterpreting the shift. He thinks AI expands the software pie instead of eating it.
And he might be right. But the market, it's not ready to believe him yet. The volatility suggests investors are just shooting first and asking questions later.
So while the software side is kind of melting down, the hardware reality, the actual physical stuff powering this, is telling a very different story. But it's not a straight lineup anymore. I mean, look at AMD. They beat expectations on data center strength. Any other year, that's a rally.
And instead, the stock lags. It's the curse of high expectations, isn't it? The bar for AMD was set so incredibly high that just a simple beat wasn't enough.
It wasn't enough.
Investors wanted a blowout. Compare that to Supermicro. They're guiding revenue above expectations specifically because of AI server demand. So the build-out hasn't stopped.
No, it just means the capital's flowing very, very specifically to the winners who can deliver right now.
Right. And speaking of delivering, you have Intel trying to claw its way back into this conversation.
Yeah, the CEO is announcing plans to build GPUs for data centers. But then he drops this absolute hammer of a prediction.
Oh, this is the big one.
He sees memory shortages persisting until 2028.
2028. That is the single most sobering data point in the entire sector right now.
I mean, 2028, that's not a supply chain hiccup. That's a whole era.
Exactly. And you have to understand why this matters so much. We talk about GPUs, the brains, right? But those brains need memory to hold the data they're processing.
Right.
If you have a memory shortage that lasts 4 years, that puts a hard governor on how fast AI can actually scale. You can have the fastest chips in the world, but if they have no memory to access, they're just expensive silicon bricks.
So it's a prolonged bottleneck that maybe the software optimists aren't pricing in.
Precisely. It puts a physical speed limit on the digital transformation.
Yet, despite that potential speed limit, some of the valuations we're seeing are completely unhinged from physical constraints. Let's talk about where the capital's going. Anthropic. They're planning a tender offer that would let employees sell shares at a valuation of at least $350 billion.
That number is just staggering. To put that in perspective, a $350 billion valuation, that's ahead of most legacy banks, industrial giants.
Things that build actual physical things.
Yeah, for 100 years. It implies that investors believe Anthropic is going to capture a huge double-digit percentage of the future knowledge economy.
And it's not just them. NVIDIA is nearing a deal to invest $20 billion in OpenAI.
Which is fascinating because it's so circular. NVIDIA invests in OpenAI.
Who then uses that money to buy chips from?
From NVIDIA. We're seeing this consolidation of capital into just a few god-tier AI labs. The barrier to entry is becoming so high.
It's an arms race with unlimited budgets.
Yeah.
But here's the contrast I find so jarring. While the AI labs get billions, the actual companies using the tech are pinching pennies.
Right.
Process NV just signed a multi-year deal with an Amazon unit, and their goal isn't innovation or magic. It's double-digit cost savings.
That's the reality for the enterprise. Everyone is spending billions to build the tech, but the customers are buying it to slash costs, to reduce headcount, lower overhead.
But is it even working? Because we have a serious red flag on Microsoft. Copilot usage is actually declining.
This was supposed to be the killer app for enterprise AI, and people are turning it off.
So what's happening? Microsoft usually wins by just forcing their product onto your desktop.
Right, but if it doesn't work seamlessly, people just ignore it. I think it's two things. Branding confusion is one, But the big one is interoperability frustrations.
Meaning?
It just doesn't play nice with the other tools in your stack. If you ask it to pull data from a PDF and put it into a customized Excel sheet and it breaks or hallucinates, you lose trust.
Okay, that makes sense.
You can't just sprinkle AI on a bad workflow and expect it to be fixed.
Meanwhile, OpenAI is looking for new frontiers.
Yeah.
Sam Altman is weighing investing in firms using AI for drug discovery. But they're also testing ads on ChatGPT.
The ad model is. It's the inevitable gravity of the internet, isn't it? The comparison is to Facebook's rise. They have to monetize that massive user base.
But it feels different than a search engine. If I ask for medical advice and get a sponsored answer.
Exactly. If the AI recommends a specific pill because that pharma company paid for the slot, that destroys all trust. It stops being an assistant and starts being a salesperson.
And all this stress is showing. We saw the Salesforce Tableau chief just exited.
Which just fuels these broader concerns about executive turnover. When you have high-level departures in the middle of a massive pivot like this, it suggests some serious internal disagreement.
Let's pivot back to the plumbing for a second. There's huge consolidation happening in chips, but not the sexy AI ones. Texas Instruments.
Right, the boring, reliable chip maker.
They're in talks to buy Silicon Laboratories for about $7 billion.
And that's a bet on the edge. They make the analog chips for washing machines, cars. Buying Silicon Labs suggests they want to corner the Internet of Things market.
But there's a physical wall hitting these plans. The state of Texas
Yeah, this is huge.
is reevaluating data center projects because of power consumption.
When Texas says, whoa, hold on, you're using too much electricity, you know the situation is critical.
The energy capital of America is running out of juice for data centers.
For these specific loads, yes, you have Infineon boosting investments to meet AI demand, but if you can't plug the data centers in because the grid can't handle it, that investment is stranded. The energy bottleneck is fast becoming the primary constraint.
And then there's the geopolitical layer. NVIDIA's H200 exports to China are being held up by a U.S. national security review.
It's a standoff. The U.S. is tightening the screws on high-end compute going to China.
And now Chinese customers are withholding orders.
In response, China looks inward. And, the U.S. is looking inward, too.
That's the note on USA rare earth.
Exactly. The CEO claims they've secured over $3 billion in funding to build a domestic critical minerals supply chain. Project Vault.
So heavy government involvement.
Right. We're seeing the total bifurcation of the global supply chain. The U.S. is trying to onshore everything from minerals to GPUs, and China is trying to do the same. It's inefficient, it's expensive, but it's the new reality.
I want to pivot completely away from the high-tech, trillion-dollar world and look at the average person. Because U.S. shopper sentiment has plummeted.
It's such a sharp, painful pivot.
Well,
while we're talking about $350 billion valuations, the average consumer is hitting a wall.
yeah.
Food and drink companies are facing massive challenges. They're actually cutting prices to move inventory. That pricing power they had, it's gone.
And Chipotle, usually the canary in the coal mine for this stuff, is forecasting sales below expectations.
And the reason is margin pressure because consumers are cutting discretionary spending. When people stop buying premium burritos, the belt-tightening is real.
We see that same divergence in autos, too. Look at Tesla versus BYD in China.
A huge gap.
Tesla's shipments rose 9% in January, while BYD saw a nearly 30% sales decline.
That's shocking. Usually we hear about BYD eating everyone's lunch. It suggests that at the premium end, or maybe just with Tesla's brand, there's still some resilience. But the broader market drop for BYD is a bad sign for the Chinese consumer.
And in the background of that, you have Ford and Geely discussing a partnership.
An American icon and a Chinese giant. It sounds like an odd couple, but it's a survival strategy. When margins compress, you share costs.
Even rivals become partners.
They have to make the math work on the EV transition when demand is so wobbly.
And housing. U.S. homebuilders are pitching rent-to-own schemes.
They have to. We are sitting on the largest housing inventory surplus in 15 years.
But I thought we had a housing shortage.
We have a shortage of affordable homes. We have a surplus of expensive new builds that no one can buy at these interest rates. So builders are sitting on finished houses acting like landlords to move them.